that you're able to realize your debts very quickly. Sorry, you're being able to sell off your inventory very quickly and for a higher number of times in a year. And since more inventory means more money is tied up in a merchandise, analysts like to see a high inventory turnover ratio. For example, so basically a lot of money is tied up into inventory. And a high inventory turnover ratio means that you're able to realize your inventory very quickly. You're able to turn that inventory into cash very quickly. And so analysts like to see a high ratio because it means that you don't keep your inventory for long. You don't have money tied up in this inventory for long. Because a low turnover inventory ratio means that a lot of amount of your money is tied up into inventory for a longer period of time. However, sometimes a low inventory turnover ratio is also good. Now, why do I say it's good? Because a low inventory turnover ratio would basically mean that you're keeping inventory for a longer time. But why do I say that sometimes a low inventory turnover ratio might be a good thing? This is when we expect the prices to rise. So when we expect the price to rise, we will keep our inventory intact. We will not sell it off. And that would mean that our inventory is in the organization itself for a longer period of time. And that is why the inventory turnover ratio is low. But this is particularly helpful in cases when we expect a price rise or when we expect a shortage in the future. For example, in case of seasonal products, for example, an ice cream vendor has a very huge, for example, a sweater manufacturer has a very huge inventory. So during the time of summers, his inventory turnover ratio is very low because his inventory is very huge and he's not selling off that inventory quickly because he knows that at the time of winters, there will be a huge demand for sweaters. And this is why the demand, and as you know, by simple applications of demand and supply, when demand rises, then price of a product also increases. So he knows that he should wait till winters. He should wait when there's a high demand for sweaters and when the demand for sweaters will rise. And this is why a low inventory turnover ratio is particularly helpful in such cases. However, normally we say that the inventory turnover ratio should be as high as possible because we don't want to keep our inventory for a longer period of times in the organizations. We don't want our money to be tied up in the inventory for long periods. Am I clear so far? Do you want me to explain anything once again?
Clear, absolutely.
Okay, great. However, so what is the formula for inventory turnover ratio? According to the formula, so these are all mathematical formulas. When you increase one component, the the ratio's answer automatically changes. So the formula for inventory turnover ratio was cost of goods sold divided by average inventory. Okay. So what is the formula for average inventory? Can someone tell me? Formula for average inventory.
Average of opening and closing.
Yes, exactly. Opening inventory plus closing inventory divided by 2. Okay. So now if I increase my cost of goods sold, that is in the numerator, my inventory turnover ratio will automatically increase. And if I decrease my average inventory, that is in the denominator, my average inventory turnover ratio will automatically increase since denominator is decreasing. Okay. So sometimes a high inventory turnover ratio can be misleading because what if our cost of goods sold is very high? Since our numerator is very high, our inventory turnover ratio might be good. But we don't want our cost of goods sold to be very high. And this is when the inventory turnover ratio might be a misleading ratio. So why this increased cost of goods sold might happen? To achieve rapid turnover, merchandise must be bought more often and in smaller quantities, which reduces average inventory. So, for example, a person wants to reduce his average inventory turnover ratio, and wants to improve his average inventory turnover ratio, and for that he would need to decrease his denominator, that is his average inventory, and to decrease his average inventory, he will buy very lesser amounts of inventory so that his inventory can be sold off very quickly and it doesn't tie up a lot of money in that inventory. Okay, but to achieve that, he might need to buy his inventory very often and very quickly. And that is, and that would not help him to achieve economies of scale. For example, you guys also know when you buy a lot of amount of goods, buy a larger amount of goods, you get a better discount than when you buy, say, 1 or 2 units of goods. So that practice might reduce his average inventory, but then it might also increase his cost of goods sold because he will be paying more amount of money to procure raw materials in lesser quantities than he would be paying to procure at them, say, a wholesale quantity. Because by buying smaller quantities, the buyer cannot take advantage of quantity discounts and transportations of economies of scale. For example, it may be possible, for instance, to buy a year's supplies of Levi's at a quantity discount that offsets the high cost of carrying a large inventory. Increased operating expenses. So now, like I said, it's a very mathematical relationship. If the cost of goods sold, that is in the numerator, increases, our inventory turnover ratio will also increase. But increased cost of goods sold means our operating expenses might have also increased. And this economy of scale can only be gained when the retailer purchases large quantities. Because when he purchases small quantities frequently, he meets with the same vendors, he pays for the same transportation, and he pays for insurance and handling fees a lot of number of times. For example, you want to carry an inventory of 1,000 units a year. Your target is you have to sell 1,000 units, but you, for example, so you can buy these 1,000 units from a supplier, say 10 times a year, which is 100 units at one time, or you can just buy it 2 times a year, which is 500 units at a time. So your average inventory at when you buy it 10 times a year will be only 100, okay? And this will give you a very good inventory turnover ratio. It will give you a very high inventory turnover ratio, which might be good on papers. But then you will realize that you're not earning enough amount because you have been paying a lot of amount in transportation and distribution and handling with vendors, when you could have just bought 500 units of inventory only twice a year and saved a lot of amount of money. And this is why there always should be a good mix of order placing, and we should always place an optimum amount of order. You guys will be learning it in subsequent sessions with other trainers, but there's an optimum order quantity. There's a formula which helps you to calculate what is the optimum amount of order you should order once a year, and what should be the amount of units that you should be ordering to reduce your cost. And this is the amount that the organization should be ordering at one point of time. So does anyone know the difference between overstocking and understocking? Like, these are very common terms used in day-to-day organizations. What is overstocking and understocking, and why? What is the difference, and why we should both avoid it? Why both should be avoidable? You guys can take a minute to think about it. Overstocking versus.
In
What is
both,
the
there's
difference?
a loss of revenue because in one you have too much of it and you're not able to sell it, like so, like you're locking in the money. And understocking is you could have sold more, but you probably did not plan, or you didn't think the demand would be that high, so you're losing onto the revenue that you could have just cashed in.
Great, excellent explanation. To further collab. Am I audible, guys?
Yes.
Okay. To further elaborate on what, sorry, I didn't get your name. I didn't catch your name.
Yog.
Yog, okay. So to elaborate on what Yog said, overstocking and understocking both should be avoidable. Overstocking means that you're keeping high stocks of inventory, and that inventory isn't being able to be realized into cash. You're not getting quickly. All of it is being kept in the organization itself. You have not been able to sell that off. And so basically overstocking would indicate that a large amount of the money tied up into inventory. Okay, that amount could have been used to finance some other operations, such as you could have bought some investments from that amount. You could have you could have bought some assets, you could have bought more machineries from that amount, but that amount is now tied up into inventory. Whereas understocking means that you have not kept enough stock in the organization. And what would understocking lead to? You could have realized that amount in sales if you had enough stock. Now, for example, if you don't have enough stock, and for example, you are Pepsi and there's Coca-Cola. Now, if Pepsi understocked, a customer like me would just simply go and buy Coca-Cola. If Pepsi is not available to me, I would be a very neutral customer and I would just go buy Coca-Cola. And this is how understocking harms you, because customers are usually very neutral. They're not very sensitive and not very loyal. So if you understock and if you're not able to deliver to customers, customers might move on to competitors. And this is why inventory turnover ratio helps us to tell us if we are overstocked or understocked. Because when we compare our inventory turnover ratios to the inventory turnover ratios of different companies within the same industry, we might be able to understand that if we are overstocking or understocking. Because, for example, there company A and company B. Say Zara and H&M. The Zara and H&M are both giants in fast fashion industry. Okay. For example, Zara's inventory turnover ratio is 4. That is, it's able to sell off its inventory 4 times a year. Whereas H&M's inventory turnover ratio is say 2. It's half as of that of Zara. What do you think this indicates? Zara's inventory turnover ratio is 4 and H&M's inventory turnover ratio is 2. What does this indicate in terms of overstocking? Okay, so basically this means that Zara is overstocking because it's in the same industry as H&M. Oh, sorry, H&M is overstocking. Zara's inventory turnover ratio was 4 and H&M's inventory turnover ratio was only 2. This meant that H&M was able to turn off its inventory, that is sell all of its inventory twice a year, whereas Zara was able to do it 4 times a year. And what does this indicate? It indicates that since they are in the same industry, Zara and H&M should almost have almost the same amount of inventory turnover ratio. And why does H&M have a smaller inventory ratio of 2/4? That is because it has been overstocking. It has been buying large amount of stock. Its inventory is very high, and that is why it hasn't been able to sell it off. And this is what caused the problem of overstocking. And this is why overstocking and understocking both should be avoidable. Now, does anyone know what is dead stock? What is the meaning of dead stock?
Which doesn't sell.
Great. Like the name itself is pretty explanatory.
Yeah.
Dead stock is a stock that is not being able to sell off. And why the reason for that might be obsolescence. Okay, so a lot of time, a lot of stock is there in the organization just because the customers don't prefer to buy it because the customers' tastes have changed with respect to time. Now, for example, Apple produced 10,000 units of iPhone 10, and then just after a month of producing those units, it launched iPhone 11. Okay, so now do you think Apple would be able to realize all its 10,000 units of iPhone 10 into sales? It might not, because when iPhone 11 has already been launched, a lot of its potential customers would want to buy the latest version of iPhone, that is iPhone 11, and a lot of iPhone 10 would not be able to sell off, and that portion would be known as dead stock. And therefore, overstocking should always be avoided, because overstocking doesn't necessarily mean that our amount is being tied up in the inventory. It also means that our amount might be lost forever, because some of the stock that has been overstocked might be dead stock. That is, it is not being able to sell in the future, and the company might have to just dispose it off at very low prices, thus causing losses to them. Am I clear so far?
Yes.
Okay. Okay, so when comparing or projecting inventory turnover, one must compare similar products and businesses. So why did I give you example of Zara and H&M? Because these two belong in the same industry. They both have the same scale of operations. I can't just compare Zara with, even though the industry is same, I can't compare Zara with, like, say, a clothes manufacturer in your local market, because the scale of operations is very vast. Zara operates on an international level, whereas the clothes manufacturer in the local market only operates on a very small level. This is why when comparing the inventory turnover ratios, one must consider that the companies operate at the same scale, they manufacture the same kind of product, and they are in the similar line of industry. For example, FMCG versus fast fashion versus automobile industry. So what does FMCG mean? Do you guys have any idea?
Yeah. FM's fast moving consumer goods, basically all the toothpaste and
Great.
and all of these such items like toiletries and all of these stuff items.
Yes, fast moving consumer good. And fast fashion, does anyone have an idea what fast fashion is?
The fast fashion are the brands H&M, Zara,
Great.
the Jack and Jones, and all of these ones.
Yeah. And versus automobile industry. So FMCG and fast fashions, these industries are fast moving. That is, their inventory realizes into cash very quickly. Fast fashion industries, for example, why do we call the Zara and H&M as fast fashion industries? This is because they produce very small units, very small number of units of their clothes as per the trends of the organization. And as soon as trend changes, they manufacture as according to the trend. So that is why their products move very fast. They are able to realize them into cash very fast. And FMCG is also similarly, FMCG also works like that. For example, bread industry. It is able to realize its products very quickly into cash because these are all perishable goods. These are all goods that don't go out of trend soon, and customer will keep on buying them because these are goods that are consumed very frequently and are perishable in nature. And now, why do I give the example of automobile industry? This is because we need to contrast it with fast industry. Now, automobile industry consists of car manufacturers and vehicles. So why do you think I want to draw a contrast between FMCG and automobile industry? What could be the reason behind it?
No idea.
Okay, so the reason behind it is, since automobile industry produces vehicles like cars and bikes and trucks, all these products have a very low inventory turnover ratio because they don't get realized into cash very quickly. Whereas for fast industry, like I explained, these get realized into cash very quickly. So for example, you are comparing the inventory turnover ratio of Tata Motors with inventory turnover ratio of Zara. It doesn't make sense because these will have very different inventory turnover ratios. It is possible for Tata Motors to have a very low inventory turnover ratio because it takes them months to sell off all its cars and realize them into cash. Because cars are something that are not purchased frequently by customers. It depends on inflationary cycles. If there's a recession going on in the economy, it's possible that the automobile industry will be in a slump, and because no one would prefer to buy cars in a recessionary mode. For example, due to COVID-19 induced recession, do you think the automobile industry might have had a very high growth? No, their inventory turnover ratio might be low because their inventory isn't being realized into cash as quickly as they wanted. And also because cars are something that last for almost years. These are not perishable goods. These are not fast-moving goods. These are goods that depend. That whose buying frequency relates to economic cycle too. And this is why we should compare the project inventory turnover ratios of industries that are similar and their scales are similar, so as to derive meaning. Because if we compare ratios of two companies which are in totally different industries, it will give us a very misleading picture. Do you guys get what I'm trying to say?
Yes.
Am I clear so far?
Yes.
Okay, great. So after that, just like debtor collection payment period, debtor collection period and creditors payment period, we have inventory conversion period. And inventory conversion period is calculated as 365 divided by inventory turnover ratio. Now, again, the same question. What do you think the inventory conversion period should be, less or high? Less or high? Can you please repeat?
It should be less in general, but for some industries it should be higher.
Yeah, great. So we'll be taking a generalized answer, which means the inventory conversion period should be low, because optimally it means that we are able to realize our inventory into cash very quickly. For example, if my inventory turnover ratio is only 60 days, it means that as soon that within 60 days, I'm able to sell off all my inventory and get cash for it, which basically means that I don't have a very high amount of investment and not a lot of my money is being tied up into the inventory. Obviously, exceptions do exist. Like I told you, for Tata Motors, the inventory conversion period might be high because it depends on economic cycles too. And lesser inventory conversion period is also better, because the more faster we convert our inventory into sales, there will be lesser chances of obsolescence and paying of overstocking costs. For example, the more quickly you are able to realize your inventory into cash, there will be lesser chances that that inventory will go out of fashion, or it will be deteriorated, or you don't have to pay storage cost for it. You don't have to pay the cost of overstocking it, because the more time you hold the inventory, there are chances that it might go out of fashion, it might get obsolete, it might get destroyed by loss of theft or fire. So it's always optimum that as soon as we produce our goods, our inventory is ready, we take less number of days to quickly sell it off and realize it into cash. Okay, so cash cycle. The cash conversion cycle is a direct link between how much time it takes us for us to realize our inventory into cash. And the cash conversion period, or the cash cycle as we call it, is known as inventory conversion period plus debtor collection period minus creditor payment period. This is the formula for cash cycle. It basically measures how long the cash is tied up in the inventory before the inventory is sold and cash is collected from the customer. Our endpoint of the cash cycle is the cash coming back to us. And why we have included debtor collection period in it? Because our cash cycle isn't completed as long as we haven't received the cash for it. Selling of the good doesn't mean that your cash cycle is complete. You might have sold off the goods, but if your debtors haven't paid you for it, it means your cash cycle is still complete. You need to be paid for those goods. So as soon as when we realize the inventory into cash, that is when we say our cash cycle is complete. Apart from that, if you have purchased raw materials from your vendors, suppliers, and you have still not paid wages to your laborers, it basically means our cash cycle should be complete only when we have paid off all of our creditors too. That is, we have paid off all of our outstanding debtors and outstanding creditors, and all our vendors and suppliers for all the credit we took from there. The cash cycle has three distinct parts. The first part of the cycle represents the current inventory level and how long it will take the company to sell this inventory. The sell this inventory basically include या तो आप इसको cash में sell करोगे या credit में sell करोगे. And the state is calculated by using the number of days of inventory outstanding calculation, which is calculated as 365 divided by inventory collection in average inventory ratio, like I just explained it to you guys. Okay. The second stage of the cash cycle represents the current sales and the amount it takes to collect the cash from these sales. Like I explained, cash cycle is only complete when when the amount from sales is realized into cash. It isn't complete as long as our debtors have paid us back. And this is calculated by using the days sale outstanding calculation, that is also known as debtor collection period. The third stage represents the current outstanding payables, that is our creditor payment period. In other words, they represent how much the company owes to its vendors and suppliers for supplying the raw material to us on credit. And as soon as we pay off all our vendors and suppliers and we clear off all of our debts and we pay off all of the creditors, our cash cycle is complete. So what do you think the final amount of cash cycle should be? Should it be high or low? What do you think the cash cycle should be, high or low? Like cash cycle is calculated in number of days. So what do you think the answer should be?
The answer should be low.
Low, great, exactly. It should be low because it means that we have been able to sell off our inventory, get the cash for it, and pay off all of our creditors. And it should be as low as possible because a lower cash cycle means that we are able to repeat this many times in a year. For example, our cash cycle is say only. For example, a cash cycle is only 100 days. It basically means we can do it almost 3.5 times a year. But if our cash cycle is say 200 days, it basically means we can only do it 1.5 times a year. That means we can't be doing the same operations more than 1.5 times a year. So cash cycles, a simple explanation is how long does it take for the firm to go from cash to cash? Because the service companies, it's a simple formula. It's a sell service and receive cash. For a merchandising company, it means buying the inventory, selling the inventory, and receiving the cash and paying for inventory. That is when they have cleared off all their debts to their vendors and suppliers. And for the manufacturing companies, they don't buy inventory. Since manufacturing companies produce the product from stage one, it means buying the raw materials, making the product, selling the product, receiving the cash, and paying for material and labors. Now, I would like you guys to think and give a very simple example from a daily life or from a daily life industry or any example of a cash cycle of any industry. Like you guys would be picking any sort of industry, any sort of business, and you would be explaining the cash cycle to me. What does it mean? If any one of you can volunteer, you guys can take like 3-4 minutes to think about it. It's all right. Any example of cash cycle? Sorry, I didn't realize I had muted myself. I'm saying you guys can take any example from a real life industry or from a made up industry. Like I just need to know you understand what this cash cycle means from stage 1 to stage N. Any sort of example.
So for a e-commerce company, the
Okay.
inventory conversion period is low.
Okay.
The debtor collection period is also low because Amazon and all these sites generally collect the payment for you.
Mm-hmm.
And the payment period is actually very subjective. So can be high or low depending on how the firm is operating.
Okay. So, what if I ask you in terms, like, can you explain it to me in layman terms? What would be the cash cycle for, say, Myntra?
Uh, for Myntra, the cash cycle,
Like, not in terms of numbers. I'm just trying to understand what is cash cycle. Like, what would be the cash cycle for Myntra? From where does it start and where does it end?
that'll be extremely hard to predict, but I think it'll be on the lower side.
Okay, so you're getting my question wrong. I'm not asking you to predict would it be high or low. I'm just asking you to tell me how does it start and how does it end for Myntra,
Okay,
the cash
so
cycle for Myntra.
how does it start? Basically, starts with raising from the creditors, wherein a timeline is decided for the payment, and then once the inventory is there, I mean, not for Myntra, but someone who's selling on Myntra. Are you talking about Myntra? Because Myntra works on a commission model.
Oh, you can explain it to me for Myntra too or like a seller too, any one that you prefer.
For a seller, the cycle would include first getting the goods on credit, and then which is covering a credit payment period. Then the inventory conversion period would be when once the goods are sold. On the basis of that, in the 365-day period, we can take out what the inventory can look like, and then there is the debtor conversion period will also be low because generally these are the payments are generally given in a weekly duration or something like that. What I've seen in the industry. So they're closed every week. So I'm not sure as to how else I can explain this.
Okay, great answer. Like you have been very spot on in explaining,
From
but in
from
very
Myntra's
actually your voice
perspective,
is cracking a bit.
can you hear me now? Am I audible?
Yeah.
Yeah, from Myntra's perspective, their revenue is so whatever money they receive, there is absolutely no debtor collection period. Uh,
Mm-hmm. Yeah.
it could be from zero to the time of delivery if it is basically
Yeah.
a cash on delivery, right?
Yeah.
So
Yeah.
the inventory conversion period is zero because Myntra generally does not keep inventory, right?
Mm-hmm.
So
Great.
whatever inventory is sold of is of those who are selling through Myntra,
Mm-hmm.
and the credit payment period is generally as I specified earlier, which is 7 days. The creators for them, the indirect creators for them is generally people who are selling on their platform, right? So
Yeah.
this is what I can make out from.
Yeah, great. Like this is what I was looking for. So basically, like you explained, data collection period would be almost negligible for Myntra because it sells off. It doesn't do credit sales, and credit sales would only be the cash on delivery sales. So our debtors would be realized in an optimum time of 7 to 10 days as soon as the cash on delivery is received. And for our creditors payment period, it will be realized just to, I would not be taking into creditors that are related to Myntra in any other way other than raising the inventory. So Myntra, what inventory does Myntra keep? It sells of products of other suppliers, other vendors. And what does it need to pay them? Uh, it needs to pay them a certain amount of money that they have realized from sales back to these vendors and suppliers for giving Myntra the products to host on its website. So as soon as the cash is realized from the customer, Myntra pays back to the vendor and supplier, and this is when the entire cash cycle for Myntra is completed. This is like, I was not hoping for an e-commerce example, which is very good. Like an e-commerce example is a bit different from a manufacturing example. So you guys must have realized what the cash cycle means. Like, is the cash cycle clear for so far?
Yes.
Yes,
Okay.
it's clear.
Okay, and the cash cycle is also very close linked to liquidity, because it means that we are able to generate cash very quickly, and as soon as we are able to sell off our inventory and realizing into cash, it means that the like, for example, if our cash cycle is say 60 days a year, it basically means that we are able to repeat this cash cycle 365 divided by 66 times a year. It means that we are able to get back our cash 6 times a year. It will be stronger. But again, when I say this, it is a very subjective term, because I have not been able to compare this with another industry. But I'm just saying it is a very close link to liquidity, because liquidity, like I explained, is directly related to cash. As long as we have enough cash to cover off our short-term obligations, we are liquid. And as long as we don't have cash to cover our short-term obligations, we are not liquid. We might go insolvent if all those liabilities come knocking down at our door one day. And the working capital, that is current assets minus current liabilities, is needed, reflects the investment required to support this cycle. So working capital basically means that the minimum amount of capital that a company should have at any point of time in order to sustain its operation. Because if the company doesn't have enough working capital, it might not be able to sustain its operations. Okay, so I think liquidity ratios will be our last topic for the day. You guys will be moving on to the next session, that is tomorrow, where you will be discussing solvency ratios and ratio analysis to basically gauge if the company is solvent or not. That would be discussed in tomorrow's session. Liquidity ratios is the last topic for the day. Did you guys have any doubt so far? Because liquidity ratios is a bit easier topic. I kept this for the end of the session, since you all must be pretty exhausted by now. And liquidity ratios will get covered relatively easier than all the other ratios. So if you guys want me to explain something again, like DuPont analysis or anything, I can do that. Okay, so should I move on with liquidity ratio?
Yes.
Okay, great. Okay, so what does this picture indicate?
Not able to manage short-term obligations.
Yeah, what does this basically mean? What does the sign indicate? What was your first reaction on seeing this sign?
Like, they don't have cash to run the business.
Mm-hmm. Yes. It basically means that, like I told you, cash is the optimum king of the organization. We need to have a certain amount of cash. We need to have a certain amount of working capital with us in order to sustain our business. Because if we don't have that, we are insolvent. It might be possible that we don't have enough cash. We don't have liabilities at the moment, but we still need to maintain a working capital. We need to maintain a certain amount of cash in order to realize our obligations if suddenly all of them come knocking down at our door at some point of time. For example, you might not have recent obligations to fulfill. All your loans are 1 month or 2 months away, but suddenly due to a recession, due to a lockdown being implemented, all your creditors come knocking down at your door, and they're asking you to be repaid at the moment. Are you liquid or you not? It basically means that you need to have enough cash to pay back all of the creditors, to fulfill all of the debt obligations if they somehow become payable at a particular time of year. And this is what liquidity ratios tells us. It tells us if the organization is liquid enough. It tells us if it's solvent enough. Because if the organization is not liquid, if it doesn't have enough cash to pay off its current short-term obligation, it basically means that the organization is insolvent. Because an insolvency is another concept where the company's long-term assets, like its fixed assets, like its building, furniture, land, is sold off to pay off its short-term obligation. That constitutes insolvency. And liquidity means that we are able to use our short-term assets, our current assets, like our cash, our marketable securities, to pay off all our debts. Because a sign of a liquid organization, a sign of a good organization is that it doesn't need to dispose or sell off its fixed assets to pay off its liabilities. You might be a company, you might be a very huge company, but if you don't have enough cash on you, if you don't have enough current assets on you to pay off your debts, you might feel the need to resort to sell off your machinery or your buildings, and it basically means that you are a very inefficient organization. So this is why liquidity ratios are very important ratios, and since these are very easy to calculate, they provide a very quick picture of the organization's current working. It measures the company's ability to meet its short-term obligations. Okay, so very basic question. What is the difference between current and non-current in terms of an organization? Current and non-current.
Current is generally a year, and non-current is exceeding a year.
Yeah, great. So it depends on industry to industry, but the standard term for all of the industries worldwide would still be, yeah.
As per the accounting standard, 1 year, or as per the operating cycle.
Yeah, exactly. But still, to maintain sanity and to make our lives easier, we consider it a period of 1 year. Okay, so these are the three liquidity ratios: current ratio, quick ratio, and cash ratio. Out of these three ratios, cash ratio is the most optimum one, because I'll be explaining why it's the most optimum one. So current ratio, simple formula is current assets divided by current liability. And what does it signify? It calculates the excess of current assets that we have over current liabilities, so that we can pay off all of our current liabilities. For example, I have a current liabilities of 100 rupees and my current assets are of 200 rupees. So it basically means that I have twice the amount of current assets to be able to pay off my current liabilities and still be left with 100 of current assets in hand with me after I have paid off all my current liabilities. So can someone of you give me an example of current asset? Some examples of current assets.
Bank, inventory, short-term investments.
Great. And current liability?
Current liabilities are short-term provisions, short-term loans.
Yeah.
Your creditors, your
payables. Yeah, creditors. Yeah, right.
Yeah. Yeah, great.
Yeah, so all three creditors: credit for expense, trade credit, capital goods, and your expense payable.
What are the examples of expenses payable?
Expenses payable, expenses which are basically payable during the year have to be recorded in that financial year.
That's true. And a particular example of expenses payable will be outstanding wages.
Basically, insurance premiums and stuff like that.
Yeah. And outstanding wages is another good example of a short-term liability, short-term obligation, because it's often seen that organizations don't pay their employees on time. they keep on delaying their payments by a month or two. And since these payments have to be made, all these outstanding payments to outstanding salaries have to be paid to its employees within a year. So outstanding wages are a very good example of current liabilities. And this is why I say a company should have a good current ratio, a good liquidity positions, because it might be possible. For example, a very simple, a very basic example is you are the proprietor of a business. You pay salary to your employees, but due to lower profits, you haven't been being able to you aren't being able to pay the salary to your accountant at the moment. You are saying that you will pay him the salary after 2 months. So his salary for 2 months are your outstanding expenses. That is outstanding wages. Okay. Now, for example, that accountant wants to quit all of a sudden. So since you promised him to pay after 2 months, you can't do that. That outstanding obligation of 2 months has become a very current, very recent outstanding obligation, and you need to pay him off very quickly. And this is why we should always have a good cover, that is a good margin of current assets over current liabilities, because there are some current liabilities that spring up upon you very quickly. There are some contingencies, for example, loss of theft or loss of fire, or a or interest payments, or payments due to payments when you want to settle a lawsuit. Suddenly, a disgruntled customer has filed a lawsuit against you, and you have to pay out payment for the lawsuit to go away. All these are current obligations that can spring up upon you anytime. And for that, you need to maintain a good liquid position, and you should have enough cash and enough quick assets. Quick assets basically means those assets which can be realized into cash very quickly. These are not cash, but they can be realized into cash in a very short amount of time. So they are almost equivalent to cash. That is why we say cash and cash equivalent. Bank balance is included in cash and cash equivalent. Short-term marketable securities are sometimes also included in cash and cash equivalent. For example, trade bills. Does anyone know what trade bills are? Okay, so trade bills are bills that are floated around by organizations to raise money. Okay, and these trade bills are payable within a period of only 7 days, 7 to 10 days. Okay, so why I said these are very quick assets, or very assets that can be realized into cash very quickly. For example, you hold a lot of trade bills from an organization, and if you are in need of money, you are in dire need of money, you urgently need money, and you have a lot of trade bills kept of an organization kept you. Trade bill of an organization means you have lent money to that organization for a short term period, say 10 days. Okay, but suddenly you also need money. So now you can go to the bank and discount these trade bills. You can exchange your trade bill with the bank, and the bank will give you instant money. Do you guys get my point?
So it's a bill exchange.
Yeah, it's basically a bill exchange, a bill receivable. When you discount a bill receivable, yeah, exactly. So all these come into quick assets. So current ratio basically means that a company has a limited amount of time, because it is an important measure of liquidity, because short-term liabilities are due within the next year itself. We don't have a long time to raise funds to meet up these obligations. And it means that a company has a limited amount of time in order to raise the funds to pay for these liabilities. Because if our current ratio is low, it's an alarming factor, because we should always have a good access of current assets over current liabilities, and an optimum ratio is 2:1. That is, you're still left with over 100% of your amount of current assets after you have met off current liabilities. Optimum ratio is 2:1. The higher, the better, obviously. But a ratio lower than 2:1 can be an alarming factor for industries that have for industries or for businesses that have a lot of debts, and that are, those are capital intensive in nature. And like I said, it means that the companies with large amount of current assets will be able to pay off the current liabilities more easily when they become due, without having to sell off long-term revenue generating assets. Because the mark of a good company is that it doesn't dispose of its assets. every company, if obligations come knocking on its door, can easily say, okay, I'll just close down this division, sell off the assets, sell off the building and machinery, and pay off my debts. But it's a wrong practice because it basically means that you haven't been able to generate enough net profit and you don't have enough cash to even pay off your debts, that you have to resort to selling off parts of a business. And this is why it's a good practice to maintain a decent amount of current assets. Okay, so the next ratio is quick ratio or acid test ratio. Okay, so acid test ratio, which is also known as litmus ratio. Okay, so if you guys must have seen, back in school, we used to perform experiments with litmus paper. It's a small pink strip of paper, and when you put it into a solution, it turns blue or red, dark pink, depending upon what kind of solution it is. If you guys must remember, and that is what quick ratio does. It gives us a very quick, very instantaneous picture of an organization. It just tells us how much deep into debts the organization is at the moment. Because since it's very easy to calculate, and for example, if I'm a creditor and I want to lend some funds to someone and I don't even have a lot of time to think about it, I'm not a very hardworking creditor. I'm just looking to dispose of some funds, but I still want to be able to have a very quick understanding of how the company would be able to pay me back. So I would just calculate the quick ratio, which would give me a picture of how the organization is doing at the moment. And I would say, okay, so this organization has enough current assets, enough quick assets. So even if I go back to them the next day to asking them to pay me back, they might be able to because they have a good, decent amount of quick assets to cover their liabilities. The quick ratio is an indicator of a company's short-term liquidity, and the quick ratio measures a company's ability to meet its short-term obligations with its most liquid asset. Current assets and most liquid assets are different because current assets also include stock and inventory. And stock, as we know, is not something that can be sold very quickly. It might take you weeks, it might take you months to realize that stock into cash, and that is why we don't include stock into quick ratio. So the quick ratio or acid test ratio is calculated as cash plus cash equivalents plus receivables, that is bill receivables, plus short-term investments divided by current liabilities. Or another formula for quick ratio is current assets minus inventory minus prepaid expense divided by current liabilities. Because inventory and prepaid expenses can't be realized into cash very quickly. What are prepaid expenses, and can you guys give me some examples of prepaid expenses?
Insurance premiums which have been paid already but are yet to be like for the next year. If I pay it, so it'll come under a prepaid expense.
Okay, and can you give me any particular example for prepaid expenses?
Insurance. There is any expenses which pertains to the month of March, but a portion of it is also for the month of April. So we generally take it as we book it as prepaid expense.
Great. Another very good example of prepaid expense can be advance tax. Okay, you have already paid the tax for months ahead. So now this is an asset. It's a prepaid expense and it's an asset because you have already paid off your obligation. But this is not a quick asset because you can't go back to the government asking for a refund. You can't just tell the government to give you back the amount that you paid as advance. It's an asset.
But isn't advance tax generally classified as an other current asset and not a prepaid expense? Because
yeah, it's
advance
calculated.
tax
It is classic. Yeah, sorry. Hello.
Yeah.
Yeah, you're perfectly right. Actually, advance tax is calculated as deferred tax asset, and deferred tax asset is an asset which is further divided into current asset and non-current asset. So, to give you a better example of a deferred tax asset, I would say the example of an advertising expense.
I'm sorry to interrupt, but isn't deferred tax asset also a current asset and not? It's never non-current asset.
No. Okay.
Deferred tax asset is always current.
No, it's not always current. Deferred tax asset.
Sorry. deferred tax asset is always non-current. But what I was trying to say was that the advance tax that is paid is not prepaid tax. Any income tax paid is not prepaid expense. It is always recognized as either other current assets or other current liabilities.
Okay, I might be wrong, but I was talking in the sense of though in the sense of tax provision for tax that you maintain. That is,
Okay.
that provision for tax is calculated as a current asset. So, so you mentioned that deferred tax assets are always calculated as non-current assets, which you are partially right about, because deferred assets are further classified into current assets and non-current assets. Why current assets? Because a part of that deferred asset is written off every year. For example, you have purchased a advertising contract of 5 years on Sony TV. You have paid 5 lakh rupees to Sony TV to advertise your product for 5 continuous years. Okay, so that so that 1 lakh of so it amounts to 1 lakh per 1 year. Okay, 1 lakh of per year, and that 1 lakh of per year is now a current asset because you are realizing that amount's worth in the first year itself. But the remaining amount of 4 lakhs will be a non-current asset. That is the definition of deferred asset. The amount of benefit that you are deriving from the from the asset gets deferred from year to year. Do you realize my point? Deferred asset, the amount of benefit that you're deriving from that assets get deferred. So the amount of benefit that you realize in the year one itself is a current asset. The amount of benefit that you have to realize from later on year is calculated as non-current assets.
Okay, sorry, I'm sorry to interrupt again, but whatever balance sheets that I've seen, deferred tax asset is always categorized as non-current. Okay, it's never categorized divided between current and non-current.
So it isn't categorized. When you will see a balance sheet, no, you will see that जितना वो amount non-current assets में आ रहा है ना, वो minus करके दिखाते हैं. It doesn't show it as a full amount. It gets deducted on each year on year.
Yeah, I completely agree with what you're saying that every year either an asset may be created or a liability may be created. So whatever changes are there, that is recognized as a notional income or loss in the profit and loss. But it is always recognized as either non-current asset or non-current liabilities, as per my knowledge. It's never bifurcated between current and non-current.
You might be right, but what I'm trying to say, it basically means that the asset has not yet been consumed. And if the asset has not yet been consumed, it basically means it's a non-current asset. Because when I talk about a building being a non-current asset, a fixed asset, it means that I have to derive benefit out of that asset for a number of innumerable years, right?
Yes.
This is why a deferred asset, so you're perfectly right in saying that deferred asset isn't shown as a proper demarcation between current asset and non-current asset. But when you see,
I understand where you're coming from, but the accounting standard has clearly specified it to be disclosed in non-current. Otherwise, you are correct in saying that some of that benefit, if it is a deferred tax, in case of deferred tax asset, some amount of benefit may be recognized in the coming year, and some of it may be recognized in the years to come. So technically, I think what you're saying is right, but as per the accounting standard, it is always classified as non-current.
okay, so yeah, definitely it is calculated as non-current asset. But the thing is, वही मैं बोलना चाह रही थी, each amount, it gets reduced by each amount. Okay, so it gets reduced on year by year. You wouldn't see the amount of building being reduced. It only gets reduced when we follow the concept of depreciation and amortization.
Are we talking about deferred tax or are we talking about fixed assets?
No, we are talking about deferred tax.
So
A deferred asset.
deferred tax asset is always created on the basis of timing differences in the profitability, right? So if the profit as per income tax and the profit as per Companies Act is different, only then, and that is due to any timing difference, which could be on account of depreciation as per Companies Act or depreciation as per Income Tax Act, which is one of the examples of deferred tax. So if it is created on the basis of that, then it's a timing difference. It's a notional asset or liability which is created. And this notional asset or liability which is created is always recognized as non-current. It is never bifurcated between current and non-current.
Okay, so it might be possible that I might be mistaken. I'll just get back and look at it. If you are, I mean, I don't know, if you are quoting accounting standards, you might be right. I might be confused about it. But to my understanding, that is how it was bifurcated. I might be mistaken. I'm sorry about that. But anyway,
Let's continue.
Okay, great. Okay, so the quick ratio shows the extent of cash and other current assets that are readily convertible to cash in comparison to the short-term obligations of an organization. A quick ratio of 0.5 would suggest that a company is able to settle half of its current liabilities instantaneously. It means that if your current liabilities are of 100 rupees, you would, if all these current liabilities become due at the moment, you will only be able to sell off 50% of them. 50% of them at the moment, and 50% of them will be going unrealized. And that is why, so for current asset ratio, an optimum ratio is 2:1, and for quick ratio, the optimum ratio is 1:1. That is, we should have at least a cover of 1:1. That is, we should have at least quick assets equal to current liabilities to be able to pay them off. Okay, so the last one in liquidity ratios is cash ratio. And the formula for cash ratio is cash plus marketable securities divided by current liabilities. Cash ratio is the simplest one, and it basically indicates that if you have enough cash at the moment, we don't include any sort of current assets that take a longer period of time to realize into cash. We basically include marketable securities. Marketable securities are securities that can be traded on stock exchange and stock markets very quickly to realize cash, and it indicates whether the company has enough cash to cover the current liabilities. It basically indicates a firm's value where the company is about to shut down. However, cash ratio has a lot of limitations and problems attached to it. It is not used in financial reporting because a cash ratio, a very high cash ratio, indicates that you have a lot of cash at the hand, which is a wrong practice because that cash could have been invested into buying new assets, into expanding, or that cash could have been invested into further investments to earn returns, or it could have been even returned to shareholders as dividend. And it is not realistic for a company to maintain excessive levels of cash. It basically means it's a poor asset utilization of a company. And even though a cash ratio should be high enough to be able to pay off the current liabilities on the hand, it should never be high enough that it indicates that the company is maintaining huge amounts and huge chunks of cash that the company is not using and it's just lying idle. Because just taking a regular example from our homes, if we have a lot of cash lying around, we generally tend to go and deposit that cash into, say, a bank account or an FD, where we are earning some return out of it, or we use that cash to buy stocks of a company. So if we, as a normal investor, as a normal day-to-day person, are using our spare cash to earn good returns, that is what a prudent, what a good, efficient company should do. It should not have idle cash lying around that is not being used to produce goods or buy assets or to be returned to shareholders. And this is why it's very unrealistic and very impractical for a company to be maintaining huge levels of cash. A formula for cash flow, formula for cash ratio is of cash flow from operations divided by current liabilities. Okay, so here's a quick example. And I want you guys to calculate current ratio and quick ratio from here. Current ratio and quick ratio. Current ratios formula is current assets upon current liabilities, and quick ratios formula is quick assets upon current liabilities. Current assets may say you guys need to deduct certain amount, certain number of assets to arrive at quick assets. You guys can take your time and just let me know when you are done. Current ratio and quick ratio. Hello.
Is it 1.67 and 1.16?
Okay, so I haven't heard answers. I'll be just moving on to the answers in a minute or two. I'm just waiting for a few more people to do it. 2-3 minutes more, then we can discuss the answers. Okay, guys, should I move forward? Or do you guys need a minute or two more?
Hello. Hello.
Guys, should I continue? You guys could tell or just type in the chat box.
Yeah, I think.
Or should I be waiting? Okay, great. Okay, so current ratio, like we know, it's calculated as current assets divided by current liabilities. Now, what would the current assets be? Stock plus debtors per investment, short term plus cash in hand. Investments are short term. We don't take into account long term investments like debentures of a company. Okay, because these debentures of a companies are long term investments. They are realized into cash in after more than a period of an year. Current liabilities in this questions would be creditors plus bank overdrafts plus provision for taxation, current and features. And bank overdraft, does anyone know what bank overdraft is? What is bank overdraft?
The credit facility given by the bank.
Yes, great.
Basically,
And it's a current liability because it has to be paid off within a year. So the amount of current assets is 12,000 plus 12,000 plus 4,000 plus 12,000, which gives us 40,000. And current liabilities are 16,000 plus 4,000 plus 4,000. So in this question, okay,
I have like confusion with respect to the future taxation because I don't think it is current in nature.
provision for taxation are both current in nature only.
Future taxation, not
It is future only because even though because the tax has to be paid off within a year. That tax obligation gets due within a
So
year
what is this
itself.
future taxation?
So the current taxation,
What kind of tax is it?
it basically means the tax that we have to pay, the income tax or the tax on profit. Tax on profit, okay? So all these two provisions are
Okay.
maintained, uh, and since these have to be paid off within the year. Sorry, hello.
Supposingly we have financial statements for the year of 2019-20. Okay.
Okay.
So closing date of 31st March 2020, the amount of tax that we recognize is the amount which is to be paid before the taxation before the year for the tax before the tax year closes, right? Which is September in general cases. So we recognize the current tax that is to be paid for the year of 1920 on the date of 31st March on provisional basis, which is current tax, which is to be paid by the month of September, right? So that is current tax. But what is future tax? Future tax, are you talking about the tax which we have to pay in 2021? What are we talking about?
Okay, so as per my understanding, future tax provision is made. So you can't anticipate when if the amount of sales of your organization, right? So this future tax provision is made in case of an overdue of amount of tax that you would need to pay in case you haven't provided for enough tax at the moment. That is the provision for it.
But there is no such provision for future tax. I mean, I haven't read anything which is related to future tax. I mean, something that you have to pay for a future year.
Yeah. So the what future taxable amount increase the taxable income, which results in you having to pay more tax than usual, and that is why the future provision is made.
If you're talking about tax or deferred tax asset
Okay,
or
your
deferred tax
voices
liability.
are cracking because I think
Yeah.
more than one person is speaking at the moment.
I'll just speak. So basically, maybe what you're talking about is deferred tax, which I had specified is always non-current in nature. So since it's non-current, it should be excluded from the calculation because we are looking at a current ratio, which is current asset divided by current liabilities, right? So if we're talking about deferred tax, specified as per the accounting standard, it is always non-current. If it is non-current, then in both of these formulas, cash ratio and quick ratio, uh, uh, the current ratio and quick ratio, they should be left out, right? Because it's non-current in nature.
Sorry, can you repeat the last sentence? Your voice was breaking. Sorry.
So I'm confused about the future tax.
Mm-hmm.
I really don't know. Have you heard of this future tax concept? Can you explain what that is?
Okay, so as far as I explained, I think we don't have a common understanding. And so, according to me, it basically means a provision for taxation which had to be maintained because we want to take care of contingencies if they arrive, if we need to pay more tax than usual. That is
Yes,
according to my understanding.
that is deferred tax.
Also,
Okay, that is deferred tax. It can either be an asset or a liability, right? But that is always non-current in nature.
I don't think that's deferred tax. Deferred tax is the tax payment that you have made for the years to come.
So deferred tax is the excess tax that you the excess tax that you had to pay today, right? The excess tax that you had to pay today because of the tax laws, the advantage of which will be given to you in the future by paying less tax, right? It's a no.
Mhm. Hello,
Did you hear what I said?
I couldn't catch the last sentence.
Okay, continue with the class. It's fine.
Okay, I can get back to you because I don't think there's a lot of time left, and I'll just quickly discuss the quick ratio once spell it. Okay, so quick ratio is calculated as quick assets divided by quick liabilities or the current liabilities. And quick ratio, we say if you're moving on to further demarcations, current liabilities that are not necessarily due within a very short period of time can be bank overdraft and profitable taxation future. Okay. So quick liabilities are calculated as current liabilities minus bank overdrafts minus profit of minus provision for taxation for future, and quick asset is current assets minus stock. And so the quick ratio is calculated as 1.40:1.
Yeah, hi, Asna. Can you show the slide of the previous
Okay, yeah.
solution once?
This one, or do you want
Yeah,
to see
this
the
one.
question?
The current, yes, the current one. I was just looking. All right, thanks.
No problem. So I think, yeah, solvency ratios would be discussed tomorrow. Okay, so apart from this, do you guys have any other doubt during the whole thing? Like, do you want me to go through something once again because we have over 5 minutes left?
No, not really. It's all fine.
Okay. I can wait for a minute or two more for if anyone wants to. Because the last session I took, I had to explain 2-point analysis at least 3 times, and you guys haven't gone beyond once. So that's why I'm just asking if you guys need me to repeat anything. I would be more than happy to do that.
Can we connect over call for after the session is over, that I can have an understanding of the future tax?
Okay, but can we get on a call on Monday?
Sure,
That's
no
all right
problem.
with you?
Yeah, that's
Okay, great.
okay. Thank you.
You might get my number from Karan Verma.
Okay. Is there a particular time that I should call?
I think you can just reach out to me on WhatsApp. I'd be available. I mean, we could fix a time that's beyond my working hours. It's all right.
Okay. Okay. Thank you.
No problem at all. Asking you guys once again, do you want me to explain you anything? I would be sharing the Excel too with Karan. He'll share it with you. It has some other sheets too, where all the ratios have been calculated once again. these are very basic calculations, the one that Excel sheet has, but it's just a quick reminder for you. Okay, so I don't think you guys want me to go over anything once again. Okay, guys, great session. First of all, thank you so much for being so attentive. You guys asked a lot of questions. You guys were really interactive, which is great. As for your doubts, sorry, I didn't catch your name. Okay, so you guys are free to reach out to me after this session, but please reach out to me on Monday because I won't be available tomorrow. You could reach out to me. I would be more than happy to take up your doubts. And yeah, I would be sharing the Excel with Karan. So thanks a lot for the session and have a great weekend, guys.
Thanks, Ashna.
Thank you so much. Thank you. You guys were great. Thank you so much. Bye, bye, guys. Bye. You guys want me to ask a question? I heard someone asking in the background. Sorry. Okay, great. Okay, thanks, guys. Bye. Have a nice weekend. You can reach out to me. Karan must be having my number. You can always ask for Karan to give you my number, and you can text me on WhatsApp. I mean, I would try to get back to you as soon as possible. Okay, guys. Bye. Have a great weekend.
Yeah, bye, ma'am.